Topic 15. Sustainable Enterprise Strategy. Sustainable enterprise strategy is the integration of long-term economic performance with environmental stewardship, social responsibility, and sound governance to create enduring value for shareholders and stakeholders. Rather than viewing sustainability as a compliance obligation or corporate social responsibility initiative, leading organizations increasingly position sustainability as a strategic driver of innovation, resilience, competitive advantage, and enterprise value creation. For modern chief financial officers, CFOs, sustainable enterprise strategy has become a core leadership responsibility that influences capital allocation, risk management, corporate governance, investment decisions, business transformation, and long-term organizational success. Leading executive CFO programs emphasize that finance leaders must expand their traditional focus on financial performance to include environmental, social, and governance (ESG) considerations that affect corporate valuation, investor confidence, regulatory compliance, customer expectations, and strategic competitiveness. As global markets evolve toward stakeholder capitalism and responsible investment, CFOs are expected to integrate sustainability into enterprise strategy while ensuring disciplined financial management and measurable value creation. A sustainable enterprise strategy is founded on the principle of the triple bottom line, which seeks to balance economic prosperity, environmental responsibility, and social impact. Financial performance remains essential, but organizations increasingly recognize that long-term profitability depends upon responsible resource management, ethical governance, workforce development, customer trust, innovation capability, and resilience against environmental and social risks. Sustainable organizations therefore pursue growth while simultaneously reducing negative externalities and creating positive societal outcomes. Environmental sustainability has become a significant strategic priority for organizations worldwide. Climate change, carbon emissions, energy transition, resource scarcity, biodiversity loss, and waste management increasingly influence regulatory requirements, investor expectations, and customer purchasing decisions. Organizations invest in renewable energy, energy efficiency, circular economy initiatives, sustainable supply chains, green manufacturing, and carbon reduction technologies to improve resilience while reducing environmental impact. CFOs evaluate these investments using long-term financial analysis that considers cost savings, regulatory compliance, reputational benefits, and future value creation. The social dimension of sustainability focuses on human capital, employee well-being, diversity and inclusion, labor practices, customer relationships, community engagement, product safety, and ethical business conduct. Organizations increasingly recognize that talent development, organizational culture, and stakeholder trust contribute significantly to innovation, productivity, and competitive advantage. Investments in workforce capabilities, leadership development, digital skills, and employee engagement strengthen organizational resilience while supporting sustainable business growth. The governance dimension emphasizes transparency, accountability, ethical leadership, risk management, regulatory compliance, internal controls, board oversight, and responsible decision-making. Strong governance frameworks improve investor confidence, reduce operational risks, strengthen corporate reputation, and support long-term strategic execution. CFOs play a central role in governance through financial reporting, internal controls, capital allocation discipline, enterprise risk management, and stakeholder communication. Sustainable enterprise strategy is increasingly integrated into corporate strategy and business transformation rather than managed as a separate initiative. Organizations incorporate ESG objectives into strategic planning, innovation programs, digital transformation initiatives, mergers and acquisitions, supply chain design, customer engagement strategies, and performance management systems. Sustainability considerations influence decisions regarding new products, technology investments, manufacturing processes, logistics networks, and international expansion opportunities. Finance leaders play a particularly important role in sustainable capital allocation. Strategic investments increasingly consider both financial returns and sustainability impacts. Traditional evaluation metrics, such as net present value (NPV), internal rate of return (IRR), return on invested capital (ROIC), and economic value added (EVA), are complemented by ESG indicators, including carbon intensity, resource efficiency, workforce diversity, safety performance, governance quality, and long-term stakeholder value. This integrated approach ensures that capital is allocated toward investments that support both financial performance and sustainable enterprise development. Digital transformation significantly accelerates sustainability initiatives. Artificial intelligence, Internet of Things (IoT), advanced analytics, cloud computing, blockchain, and automation improve energy efficiency, optimize resource utilization, monitor supply chains, reduce waste, and enhance sustainability reporting accuracy. Data-driven technologies enable organizations to measure ESG performance in real time while supporting predictive analytics for climate risks, operational efficiency, and long-term strategic planning. Sustainable enterprise strategy also strengthens enterprise risk management by addressing emerging risks related to climate change, environmental regulation, supply chain resilience, labor market dynamics, cybersecurity, stakeholder activism, and reputational exposure. Scenario planning increasingly incorporates sustainability variables alongside macroeconomic and geopolitical factors to improve strategic resilience and organizational adaptability under changing global conditions. Investors and capital markets now place greater emphasis on sustainable value creation. Responsible investment funds, ESG rating agencies, regulatory authorities, and institutional investors increasingly evaluate organizations based on sustainability performance alongside financial results. Companies demonstrating strong ESG performance often benefit from improved access to capital, enhanced brand reputation, stronger customer loyalty, lower financing costs, and greater long-term resilience. The Global Competency Framework reinforces this perspective by identifying strategy, governance, risk management, business models, integrated reporting, business ecosystems management, and value creation as essential competencies for executive finance professionals. Modern CFOs are expected to integrate financial and non-financial information into strategic decision-making, support sustainable business models, manage long-term risks, and communicate enterprise value creation across multiple stakeholder groups. In today's rapidly evolving global economy, sustainable enterprise strategy has become a fundamental source of long-term competitive advantage rather than a compliance requirement. Organizations that successfully integrate sustainability into strategy, investment decisions, governance, digital transformation, and performance management are better positioned to strengthen resilience, drive innovation, attract investment, and achieve sustainable enterprise value creation for both shareholders and society.